Picture this, you're minding your own business, watering your houseplants in the nude, when you get wind that a Big Four bank is dropping their fixed home loan rates. You run, dripping wet and naked to your computer to lock in this incredible deal. Not so fast. Experts are saying you could be walking into a trap. And also, can you put some clothes on for God's sake? Remember the good old days when banks made naive mistakes?
Ooh, bank error in my favour, please collect $20.
Well played, moneybags.
Hey.
Well, now banks are shrewder than ever, with experts warning variable rates are on the cusp of dropping and the time is nigh for a fixed rate trap.
What will happen in a fixed rate trap cycle? The fixed rates start to fall much faster than the variable rates. The major banks cut their rates by like 0.75%. That looks really, really attractive. The challenge is that so many people fix for 2 and 3 years, and yes, it's great today. Problem is the variable rates generally follow 6 to 8 months later. Problem from that is that if you go to break it, you will incur break costs.
It's a trap!
The trick here is not to fix too early. They want to do that and get you locked into a 2 or 3 year fixed rate now because they can see that there has been a momentum change in the money markets and we are more than likely, if not definitely, going down.
Basically, you've been tricked into jumping the gun. And now you're locked into high fixed rates when everyone else is enjoying low variables. And to get out of it, you'll have to pay excessive break costs. Yuck.
Bank tactics not in my favour, please pay $6,000 to get out of it.
Not so clever after all. Now pay up!
Last cycle, the fixed trap worked on Anthony. Got him real good.
So in 2018, when we took out our fixed rate loan, rates were at 4.99%, which we thought were quite good. But several years after that, we saw variable rates drop to around 3%. When we broke the fixed rate term, I think our break costs were about $6,000. And yes, it did come as a bit of a shock to us.
The fixed rate trap. Be alert and alarmed.
Before signing up for a fixed rate loan, I'd recommend you understand what the break costs are.
It's really important not to jump at the first carrot that gets dangled.
Oh, I won first prize in a beauty contest.
Now read what it says in pen.
Sit on Kate's lap. Is this a trap too?
Sort of.
Wow, we are live from the lands of the Cooler Nation, and economist Evan Lucas joins us now to talk the rates trap. Evan, just how sneaky are the banks with this stuff?
Yeah, hi Sarah. Look, I think you've got to remember what banking is. Banking is actually, when you boil it down, a fairly simple thing. They borrow from you, term deposits, cash rates, put a margin on it, and then they lend it out to you. Now, if they're going to fix you for 2 to 3 years, considering that they're probably at the peak of interest rates, that rate for them stays higher, but the cost of funding it gets lower. So they make a bigger margin. So first and foremost, they're going to make more money out of you. Secondly, you're then also going to find yourself, okay, yes, right now, you are probably a little bit lower than what everybody else is paying, but over the longer term, the cost of that is going to be higher as rates come down. So that's the catch why it's there and why the banks like it, because they will, over time, make a bit more money out of you.
Evan, good to see you. Thanks for getting dressed after the gardening situation. There must be circumstances where you should actually fix, though. So when should people fix their rates?
Yeah, we saw that. We saw that. Yeah, we saw that during COVID. So there are still people that are in fixed rates from the COVID period. So those that got 4 and 5 years out of COVID are still there. And don't forget, the cash rate was at 0.1%. A 4-year fixed rate back in 2020 was 1.9%. And so that's what they're still paying. So it makes absolute sense to do that. Going to put a caveat. The other thing to remember, once you actually finish your fixed rate period, you don't necessarily jump back into the discounted variable rate. The loans are normally sort of set up so that you go back to the standard variable rate. The standard tends to be about 1% above the discount. So you need to ring your bank immediately once your fixed loan does jump off.
So, Evan, we know the house always wins, not the homeowner's house, the bank. But so how low will rates go?
So, Kate, let's actually use the bank's own economics teams across the Big Four, including also Bendigo and Anglo Bank. All of them are forecasting by Christmas next year that rates will be about 3% for the cash rate, which means 1.35% out of your current variable mortgage rate by Christmas next year, if their economics teams are correct. that once the RBA starts cutting, it'll cut all the way down to about that number. So you need to factor that in. Is the 2 years of locking you're in now versus the months that you're going to wait before rates start coming down worth it? That's something you need to do at the kitchen table to work out what's best for you guys.
Sighs of relief all over the country.
Oh,
Evan,
my
let's applaud you for that,
Yeah.
mate. We don't often applaud economists on this show.
Finally, some good news.
Well, it's going to be fun to play that back at the end of next year. Let's not get ahead of ourselves.